Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
I apologize for the delay. G Swizzle was impaling himself with his technology, but it's 11:03 a.m. on the East Coast. Market call. You will notice that Elizabeth Thomas is joining us. She of Milwaukee Brewer fandom, the Brewers that can sort of stamp their ticket to the National League Division Finals, if in fact they emerge victorious this afternoon, late afternoon, against the Cubs of Chicago. How are you, Elizabeth? You're fine, I'm sure.
I'm wonderful. Thank you for taking the blame. The technology problems were all mine, but we're here now.
So, we are here now.
And the countdown is on for 5:08 p.m. Eastern time, give or take a minute on either side, when first pitch should be thrown for this Brewer game. I think that it's time to get the brooms out and a dustpan and just take care of it, right? I know it's a 5-game series, but let's just get rid of it in 3. Why not?
No, you want to do that. Last night, the Yankees staved off elimination, down 6-1, and came back in glorious fashion. So they play this evening, 7 p.m. in the Bronx. Cam Schlittler on the Hill.
We talked about this. It sounds like a Wisconsin guy.
Yes, he does. He's from Massachusetts. Anyhow, we're not tasked with that. We're tasked with trying to figure out what the market's doing. And here we are, an S&P 500 basically at all new all-time highs. The NASDAQ continues to do its thing. The VIX has been sort of very tame here. Even the Russell's starting to pick up. We've seen the volatility in currencies. That, to me, continues to be a bit of a red flag. Bond market tame. The gold market continuing to tell a story. But, in terms of that, that's sort of overarching themes. Now, you've talked about the potential for this thing to sort of drift higher, accelerate into the year end. And here on October 8th, that's exactly what we're seeing.
Yep. And yesterday on CNBC Closing Bell, I said on my way to the New York Stock Exchange, I read a tweet that said there's a bubble in people talking about bubbles.
Yep.
And that stays the case today. We're going to talk about it all we want, but it continues to inflate if it is, in fact, a bubble. I think at this point, it's at least a speculative fervor and something that investors are clearly excited about. But look, the reality is, if you compare it and even take it over history, compare it to the late 90s, do it whatever, slice and dice it whichever way you want, it's not as extreme as it has gotten in the past before something like this might burst. So some of those measures are, we still have speculative positioning. And when I say speculative, I mean futures positioning. So people assuming, what they think is going to happen in the future. A lot of that positioning is institutional investors because they just have an easier time buying futures. But that positioning is net bearish. And when you've got net bearish positioning, there's still a little room, especially in the end of a year, where those investors are going to have to play catch up in order to match performance goals and whatever else they need to do before the end of the year. So you might have this squeeze as that net bearish positioning has to give up a little bit and become more bullish into the end of the year. And then there are a number of other metrics. Yes, we're hearing about new deals every day. We hear about IPOs, not every day, but it's happening more often than it was earlier in the year. But the average deal size of IPOs and the number of IPOs, far below what it was back in the 90s, far below even what it was in 2019, 2020, and 2021. So we haven't even knocked on those doors yet. Activity's heating up, but it's not extended to that point. And then even valuations, yes, they're high. They're at 22, almost 23 times, maybe 23 by now. But back in the late 90s, they got up above 24. So we're not there yet either. So anyway, my whole point is it a bubble? Perhaps. It continues to look like one. It continues to feel like one. But is it close to bursting at this point? I don't think so.
No, it doesn't appear that way. And, that's a term that I try to avoid. I think you do as well, because, as we've learned historically, they can last a lot longer than people think. And, you only really know that you're in one when you get out of one. So, and that's not trying to be glib here. That's just the way these things work. But you mentioned some of the valuations that have still not reached levels that we've seen historically. There are some that have. So that's sort of the push me, pull you. And at this time of the calendar, and you just said it, it's clear what's going on now. October 8th, the chase is on, and people that have underperformed and those net shorts, whether they're steadfast in their beliefs or not, these people are going to get, these institutions, whatever they are going to get squeezed. And I think to a certain extent, that's what we're seeing. We've been seeing it for a while, and then it's probably going to sort of speed up with each passing day. Now, historically, October, strange things can happen, but as you're sitting here today, you're sort of hard pressed to figure out what that event is, what that, I don't know, catalyst is going to be, because for the life of me, I can't figure it out. What I will tell you, and I'll continue to say this, and I think you agree with this as well, something's going on with the gold. I mean, the gold market, and we can throw up a chart. I mean, the gold market is telling us something. I mean, it's not just speculative furor that's going on, or fervor, right. I should say. There's something more going on. And it's been, Sarah Eisen actually just tweeted this. Maybe Jacob or Amanda can find her tweet. It's the last one she put out. I mean, gold has become like the second biggest reserve behind the US dollar. And think about that. And that's just all on central banks buying. And my stance. I mean, I do think that central banks are they're hedging against themselves. I won't use the term ineptitude, because right now, seemingly everything's coming up roses, but they're clearly positioning for something. And, gold goes up with the equity market going up, with the dollar going up, dollar going down, yields up, down, doesn't matter. Gold continues to win here. And Dan and I talked about this yesterday, but I'm just curious your takes. There's right now, I mean, it's just every single day we walk in, it seems to be, $40 higher than the prior day.
Yeah. So I, as you were saying that, I was just pulling up in real time what the dollar has done year to date. It's down about 10% year to date. That has a lot to do with it as well. I think if I had to say this in one sentence, what's going on in the gold market, it's that confidence in fiat currencies is low. And that's not just the dollar, that's around the globe. And confidence in central banks being able to affect fiat currencies is low. And that's not to say that all central banks are inept or that there's something wrong with them. They're all doing it wrong. But the controls and the things that have gone on in the currency world over the last couple years, I think has given central banks around the globe less confidence that they have control over their own currency and that they have control over their own spending. So I think that's a lot of what's happening here. Mario and I tweeted something a few days ago. If you can't find it, that's okay. But if you guys just want to search while I'm talking about this, it was basically the gold flows into ETFs. It flows into gold ETFs versus what we're seeing basically from institutional investors. So you've got the gold price, right? You've got the price of gold we know is above 4,000 now. What's the next stop? 5,000? I mean, yeah. I think it could get to 5,000 before year end. And that just sounds crazy. If we would have talked about this 2 years ago, I mean, you and I were on the gold train for a while, but if you would have said to me, could it be 5,000 by the end of 2025? I'd be like, nah, that sounds a little high. That sounds like a bit much, right?
But yet here we are. And, the move that we've seen mirrored. So, you mentioned the move in the dollar, which you're correct to mention, 10% this year. And by the way, it's sort of stabilized. We'll talk about that in a second. But this is the worst year performance for the dollar since the almost in 50 years, since the early 1970s, which, by the way, to your point, sort of coincides with what we're seeing in the gold market to a certain extent. And you mentioned the dollar. We've had that chart up, and we'll take a look at it. The majority of the DXY is the euro. I think we understand that. But part of it is the Japanese yen, the British pound, Canadian dollar, Swedish krona, and the Swiss franc sort of make it up. But there's something going on here with dollar yen. As we're sitting here, I'm looking at a dollar yen that's 152.5-ish, and we can throw that chart up. I mean, this is now the highest level in dollar yen. The weakest the yen has been since early this year. When I say early this year, probably February-ish or so. And that coincides somewhat counterintuitively with yields going higher in Japan. So something's amiss, clearly, because they have bond yields going higher and a currency that's weakening on the back of it. So the issues there continue to manifest themselves, but nobody seems to care about it here. And, maybe I'm wrong to point it out. I have no idea. But the move in dollar yen is pretty extraordinary, in my opinion.
You know what I call that? A relationship problem.
I love that. I love that.
This is not how it's supposed to work. So you are right to point it out. And I believe that relationship problems fix themselves over time and go back to their long-term typical relationship. So with a yen that is weakening and yields that are rising, you're right, that's not how it should work. If yields are rising, that effectively makes those bonds more attractive for investors. They should buy those bonds, which would then strengthen the yen. That's not what's going on. So I think back to my original point of what's going on in the gold market is a low level of confidence in fiat currencies. And I think the Japanese yen is a victim to that right now, particularly with everything that's going on in Japan. Things changed. We had a big surge in the equity market when a pro-stimulus leader came into power. So there's obviously the economy needs help, right? And I think that's probably affecting the currency market, but the yields, you're right, something's wrong there. And the hard part about relationship problems is that you never know which one of the variables has to move to bring it back in line. But chances are one of them will change direction to bring that relationship back in line.
Yeah, and I'm hard pressed to figure out what it is. But we're gonna find out. I mean, this is, to your point, this is not going to last in perpetuity. By the way, I failed to mention, if it's Wednesday, by the way, it is Butters, so we have some of his work, and we'll take a look at that. But meanwhile, as people point out, Gary points out, EWJ. EWJ is the iShares MSCI Japan ETF, which I believe is making an all-time high here as we speak. Their equity market continues to sort of crush, and that's not necessarily counterintuitive. With a weakening currency, you can see how their stock market's going to sort of benefit from that. But the whole thing to me is, you talk about circular in nature. I mean, we've had conversations about that regarding AI. I mean, that's what it seems like here. With that, let's move on to your note, because this is, as I love all your notes, but this is about as fascinating as it gets in terms of what we've seen, just the work you've done on the hyperscalers and capex and those types of things. So walk us through it. I will spare the audience the whole SoFi.com/hyphen, that whole thing, because we've been through it before, although we will put that slide up. But walk us through the note that you and Mario constructed.
Yes. So this is hot off the presses. My writing deadline is 11 a.m. on Wednesdays. And as you know, we started this show at about 11:03. So we literally put a period on the end of this note, and then I went live. So the note this week is titled Mind Your Margins.
Love that.
And the hyperscalers capex is part of this, because we're about to kick off another earnings season. Now, we know that earnings season begins with the big banks. I'm not talking a lot about the big banks in here, but earnings season for Q3, again, expected to revolve around technology and communications. And when you look at what the expectations are for earnings growth in Q3, you've got tech and communications as the strongest expected growth rate. So the story remains largely the same. But as we know as well, it's not usually about the results themselves. It's about the guidance, and particularly the guidance on what capex spending is going to be for the rest of this year and into 2026. I don't expect that the guidance is going to change all that much during Q3. Companies are likely to talk about spending through the end of the year, maybe start to hint at what would happen in 2026, but that's something that we probably hear about as the quarter goes on. So this is growth rates and capex, what we're looking at here on this chart. The lightest blue is 2025 growth. Capex still growing at a clip of 56%. That's crazy. 2026, it's expected to slow to only 21%. So that's actually where I think things are going to get interesting, because if we're so accustomed to this capex spending cycle, spending spree of 56%, I don't remember what it was last year, but something even higher than that. And these numbers have gotten so astronomical, the companies that are spending on it, and now some of the circular funding that's going on and the deals that are happening in order to support the spending. When we get into 2026 and spending slows to only 20-ish%, what's the market going to think about that? I don't know the answer to that. Maybe we'll get a good enough warning and the market will digest it. I think what really needs to happen is that profits need to start to materialize to support the spending. And if profits start to materialize, then markets can still be optimistic based on profit growth. But if it's just a message that, hey, we're going to slow down our spending because we've spent enough, that's going to be tough to digest. That all being said, I don't think that's necessarily going to happen during this earnings season. I think this earnings season is still going to be quite strong. I think we're probably still going to beat expectations. We're going to have more companies than usual probably beat expectations. And I think this is in Butter's note later, but something about, if the expected number of companies beat expectations, earnings growth will actually be much higher than it's projected right now. So that's something to watch. The next chart that go ahead.
Let me real quick. First of all, mind your margins. My grandmother used to say to me, "Mind your manners, little guy." I think that's where you got that from. So I do pay attention. And real quick, you mentioned the numbers are getting bigger, which makes sense, but the growth rate is getting smaller, which also makes sense. And your point is well taken. That how is the market going to interpret that? I'll say this in terms of, that's just all hyperscalers, but we've seen that to a certain extent with NVIDIA. And I know you don't want to play individual stocks, and I'm not going to make you, but it's a very similar thing. Their growth rate in terms of revenue growth, at one point, it was, I think we were talking about a 60% revenue growth beat and guide higher. And that's obviously the growth rate has gotten smaller, but the absolute numbers have gotten bigger. Yet NVIDIA continues to be rewarded for it in terms of the individual stocks. So we'll see how this plays out in the aggregate. But your point is, this is exactly right. By definition, things almost have to slow. And I think they can keep at this pace. Anyway, let's go to your next slide.
So this is the mind your margins piece. This is the chart that we basically kick it off with. The concern has been and continues to be, when and how will tariffs eat into margins? And are companies going to start to experience this compression in margins because the message has been that companies are maybe not passing through all the tariff costs and they're going to eat the costs? So it hasn't happened yet, but Q3, given the lags that we've sort of calculated, Q3 might be the first time that we start to hear in hard numbers how tariffs have started to affect margins for companies if they haven't passed through those costs. The reason for putting this up, and this is just trailing margins, this isn't even projected, this is what's actually happened. The reason we're putting this up is because we've got this little trend channel here. And for those math nerds out there, stats nerds out there, the dotted lines on either side are half of a standard deviation away from the long-term trend. And then you see obviously the long-term trend there in the middle. Right now, we've got margins that are slightly above the long-term trend. So we're in a really healthy place coming into this. Now, we're not way above that upper bound, but that only happens in extreme situations. So that shouldn't be something we should expect. But coming into this slightly above trend, even if we start to hear from companies that tariffs have compressed their margins slightly, there's a buffer here. And I don't think that this is something that the market is going to freak out about, even if we do start to see that in the hard data. So we wanted to put this up and just show, here's where we are. And over a long-term period, this is a pretty healthy place to be. So I think it's important for people to keep this in mind. It's important to watch as we go through this earnings season, but probably more importantly, next earnings season and the first half of 2026 when tariffs really start to come in.
So I love this because if you were to take, and I'm not asking him to do anything, but if you were to take away that channel and then look at this without the channel, you'd say, oh my God, given where we are historically in terms of margins, we are setting up for a downturn. And as those gray large bars demonstrate, downturns coincide with the recessions, the last one being a very small one in 2020 for a lot of different reasons, but the major one being sort of 08 into the middle of 09 or so as margins decrease. But if you look at it with the channel intact, you say, well, wait a second, as Elizabeth just said, we're basically right in the middle of this up channel, and there's nothing to be alarmed about. So it's amazing how different this can look just by virtue of putting that trend channel in.
Right. Well, and also look at the lengths of time that it sort of stays within that trend. If you want to look at, so between 2009 and about 2020, that line stayed well within the trend. So who knows how long this could go on for? Of course, it could go outside those dashed lines pretty quickly if things change, but it could also last for a while. So anybody who's out there saying, I know where we are in this cycle and, we're at a certain date or a certain year, nobody knows. Nobody knows where we are. Nobody knows how long this will last. The whole point of putting this up was to say, okay, yes, there's been a lot of consternation about margins are going to get compressed. They're going to take a hit. Well, even if they do take a little bit of a hit, we're still okay.
All right. Now I'm going to segue to a question because this is a logical time to do it. This is from Keith Polnick. What is Elizabeth's? I love the fact that other people call you Elizabeth now. take on small caps. Will they ever outperform large caps? Ever is a long time. But
yeah.
I mean, I think, in terms of just the here and now, the IWM right around an all-time high obviously has been underperforming the broader market, largely comprised of small and regional banks. So there's a lot here to digest. But thoughts on this? Because as you can see, 200-day moving average is basically flatlined for a while.
Yeah. So to the question very directly, will small caps ever outperform large caps? Yes, over periods of time, they will outperform large caps. And I think they actually have a decent chance at outperforming large caps into the end of the year because they're playing a catch-up trade. I want to be very clear that I view that as a catch-up trade. Large caps have been the winners for the better part of the last 3 years, 2 or 3 years. Small caps have gone really basically nowhere since 2021. They just finally made a new all-time high. But if the environment that we're in stays intact, so if we've got a Fed that is looking more and more dovish as we approach 2026, maybe we get 1 or 2 more cuts this year. If the labor market stays intact, if we ever start getting that data again, and we've got an economy that continues to hum along, doesn't need to be at a fast clip, but it needs to continue to hum along, then I think small caps do continue to see more upside and could outperform through the end of the year. Also, small caps will usually outperform large caps quite a bit coming out of a recession, but none of us are hoping for that as a scenario where we see small cap outperformance. I will tie this up with a bow to say that if this is a Fed adjustment cycle, meaning they just cut rates to get back to neutral, not cut rates because we've hit some sort of recession, large caps tend to do better in that scenario over a longer term period. So if you're looking out 12 to 18 months or even 2 years afterwards, large caps tend to do better.
Quality is something that we should all be focused on. My grandmother, same grandmother, by the way, used to say, it's quality over quantity, little guy.
Mm-hmm.
And that
usually we
leads
say that when we're talking about friends, right? So if
yes, or a lot of things, quite frankly.
A lot of things, sure.
Clothing, friends.
Yes.
I mean, just you name it. And anyhow, let's go to your next slide because this speaks to exactly that.
Okay. So this was one of those, this was really fun because this was one of those where I was like, Mario, I have an idea. Try to chart. And I said what I wanted him to chart, and I knew the relationship I wanted it to show. And then you know what? It did exactly what I wanted it to do. That's not always the case, but it worked in this case. So since April, so the last few months, since April, particularly Liberation Day or the bottom in April on April 8th, low quality stocks have outperformed high quality stocks. We know that, right? We've got meme stocks that came back up. We've got a lot of unprofitable stuff that's been performing really well. That's usually what happens when you have a risk on rally. It makes perfect sense that low quality has outperformed. I wanted to find out if there was any relationship between earnings growth and quality, and it turns out there is, and it's a pretty stark inverse relationship. So what we're looking at on this chart, you've got that gradient line with red and blue. When that line is above 0, so when it's bluish, that means high quality stocks are outperforming. When it's below 0, reddish, it is low quality stocks outperforming. Now, this is a long-term trend of high quality versus low quality, but even if you just look at the very end of this chart, you can see that low quality has gotten even better in the last few months because that red line has gotten deeper down on the axis. So what's the relationship here? When earnings are strong, and this is absolute earnings, not earnings growth, but whatever, same. When earnings are strong and rising, there's obviously more risk appetite in the market. Low quality stocks are being bought up more. Investors feel good about everything. The trick here, and again, this is difficult, if not impossible to time, but it is something that we can watch. The trick is that we know that markets sniff things out sooner than we usually get the actual data, whether that's earnings data or economic data. The market sniffs it out early. So if you start to see a turn where high quality stocks come closer into the forefront, people start gobbling up high quality over low quality. And this is something you can track with factors we can update as we go. But if you start to see that turn, it might be because we should expect a softening in earnings. So as we enter third quarter earnings, we're obviously going to get more concrete data from companies, but I want people to really pay attention to that high quality versus low quality spread. Now, I don't expect this line to suddenly shoot up and make a big marked difference as we look at this as a long-term chart, but we can do it over weeks and even over months to see if there's any change in the trend line.
The one that, I mean, what sticks out to me like a bit of a sore thumb is you go back to 08 and 09, and I think we all remember what was going on there. And, that was the downturn as manifested. Is that dark blue? I can't tell. Give me the color of that.
It's black.
So,
the
is
earnings
black.
line is black.
Oh, okay.
Yes.
Well, it's funny. The Yankees, a lot of people think the Yankee insignia is black, but actually it's not. It's a blue, just like this is a black instead. Anyway, I digress again. But as you saw, finally, the earnings downturn, you saw the stark outperformance, which, I wouldn't have thought that, but clearly the numbers don't lie. And, you've seen it a little bit before with some of these things. But the question is, given the trajectory of earnings here, and it's been significant over the last, 4 or 5 years, what's going to trigger that downturn? Because if you were to see earnings start to go the other way, and this is going to be something we'll talk about with Butters, well, not with him, with his work, you'll see I think to your point, you're going to see a pretty quick pivot in the market going from these low quality names to some of the high quality names. And then the question is, what happens to the broader market in that scenario? Again, I love this chart because it's just, I'm glad you thought of it. I wouldn't have thought of it, but it speaks to what potentially could happen if that pendulum swings.
Yeah. And in the chart, like I said, this is such a long-term chart, so it's hard to see the shorter term periods, but the market does sniff it out ever so slightly before. And that's why you want to watch for some of those turns. Now, of course, the line jumps around. So we've had quite a few head fakes in there. You can see times where the red line on the bottom has turned up and it really didn't mean that much to earnings. But usually that earnings line is gyrating a little bit afterwards, and it's something to just keep an eye on. So that would be the warning that I sent out. But broadly speaking, this note was pretty positive in saying that Q3 earnings season expected to be strong. I don't expect there to be any terribly negative surprises. The market's reaction to earnings season may be much like what happened in Q2, where companies were meeting expectations and still getting punished. So there might be some of that going on, but the fundamental story itself, I think, stays intact for Q3.
You mentioned head fake, and I apologize. By the way, Amanda is doing great. During my Neanderthal years on the gridiron, quarterbacks would love to pump fake and, would get the defensive linemen to put their hands up. And what we were taught, in case anybody cares, is when the quarterback was out of the pocket, don't buy any of that bullshit pump fake, because you know what? Just put a bullseye on the man's chest. Do not sort of go for the fake and run right through the MFer. Now, I chose not to. Yeah.
Violent guidance. Okay.
But yes, but you know what? It's amazing to me, even at the NFL level, you will see over and over again a guy like Patrick Mahomes, who is out of the pocket, those bullshit pump fakes, and guys continue to fall for the same gag. They got to stop.
Okay.
Anyway, sorry.
Well, PSA for all the NFL quarterbacks out there: either stay in the pocket or get out of the pocket and just run, which is what you're probably going to do anyway.
Well, but they all do the same thing. They do that little pump fake, and then the defense, whoever's chasing them, invariably will put their hands up, and then whatever. It makes me crazy. Sorry. That was my PSA, and your PSA on top of it. With that said, as you know, John Butters is the senior earnings analyst at FactSet. His work drops at the end of each week, but we are privy to it prior to, and we love doing that. From time to time, Dan and I join John Butters live, and we'll have him on ours, and we will join him. Today, we just have his work. So without further ado, which is a French word, let's put up this slide. The S&P 500 is currently expected to report earnings growth of 8.1%. Now, I think at one point, we were talking about, low single digits. So that's obviously exceeded. But, we're probably not close to where we've been historically. But now comes the caveat. The index will likely report actual earnings growth above 13% for the third quarter due to companies reporting positive EPS surprises. And I think that's one of the things that you're talking about. Over the past 10 years, 75% of S&P companies have beaten EPS on average. Companies have beaten EPS by estimates by about 7% on average. The actual earnings growth rate has finished above the estimated earnings growth rate in 37 of the past 40 quarters. And there you go. I mean, that was, if you think about the chart that you brought up with the black line, not the blue line, That speaks to exactly this. So
That's
here
right.
we are with earnings growth coming in higher than people expected. And I think for a lot of people, that will be justification of a market, as you said, trading close to 23 times forward earnings. So when you look at this, I think this just sort of galvanizes or sort of cements some of the things that you were talking about earlier in the show.
Yeah. And so this average number, 75% of S&P companies have beaten EPS estimates on average. Last quarter, that was 81%. It could be right around there this time as well. So to my point earlier, to John's work, 8.1% expected, but it probably comes in closer to 13%. There's more justification that the rally is deserved to be happening and that fundamentals are supporting extended valuations. And there's also the argument out there that maybe because of the composition of the market being so growth heavy, that long-term average PEs are just not useful anymore. Long-term average PEs are using a lot of companies that are not as growthy, and growth companies are just more expensive. That is what it is. I don't tend to subscribe to that entirely because I think at some point there has to be a drawdown again, and you'll get a PE that goes down quite a bit and pulls the average down with it. But to this point, Q3 expected to be strong. One of the things that it's not in this chart, but I'll talk about it because I put it in the note as well. If you look at calendar year earnings, so this is something, there's a section in my note that says the usual suspects and then one dark horse. And I want to talk about the dark horse in this context. Calendar year earnings, the third strongest sector for calendar year 2025 is, guess what?
Tell me.
Healthcare.
You want me to guess?
Healthcare.
Stop. No, there's no way.
Yes. So you've got tech coming in, expected 21% growth, communications coming in, 18% growth. Those are the usual suspects, right? Third strongest earnings growth in the index expected to be healthcare at 11.4%.
I would have said financials or
Or
something.
industrials,
or
anything but, right? So when you talk about a catch-up trade, I know we talked about small caps before. I think healthcare's got to catch up to some of these fundamentals.
I agree with you.
And third quarter is not expected to be great, pretty flat for earnings growth. But this is a sector that's only up 6.6% on the year, and it's probably gotten about 5.5% of that in the last month. So healthcare has started to perk up. The fundamentals are there for the calendar year. I've said it before, I will say it again. I think there is an opportunity there.
I agree with you. And, with that announcement out of the White House a week or so, whenever the hell it was, week and a half or so ago, the bullseye, I think, has now been taken off their collective backs. And listen, a lot of these companies have patent expirations coming up and the patent cliffs, and we've talked about that. But that is more than made in terms of the valuation, these trough valuations. So I think that's more than taken into consideration. And now that the political bullseye is off, a lot of these stocks, a lot of these big cap pharma names are still high single digits in terms of price to earnings. And if you just get back to even a historical trough valuation, there's probably another 30 or 40% upside for these names. So I agree with you. Before we get out of here, sorry about that. Let's just go to where we can find John Butter's work, because I love this slide as well. Throw it up there, please, people. There it is. FactSet.com/insight/subscribe. If you want it in your box, why wouldn't you? At this point, I'm sure everybody has one. And whilst we're at it, throw that up for SoFi too, because I just, this is fantastic. SoFi.com/on-the-money, or just go to the website.
You can go to the website, and Butter stuff just has slashes instead of dashes.
No, I understand.
It's it's there. And the other thing, you can get it in your inbox, or you can search it online. You can do the same thing with Butters. You just Google, we'll search it, or your favorite search engine.
Yeah, or your favorite, exactly. Yeah, my favorite search. Dan uses that expression, drives me crazy. I sent in the group text, and I don't know if Jacob or Amanda can throw this up, but the circular nature of all this AI spend. And, a lot of people have been writing about it and talking about it. But then Doug Cass just sent an email that we will put in the show notes. I think it's from Praetorian Capital, if I'm not mistaken. And the premise of it is, we all know what the spend is, the capex spend. But what's that expression? Is the juice worth the squeeze? Do people say that in the Midwest? Yeah.
Sometimes it's like all bark, no bite. Different meaning, but
you follow what I'm saying. And at some point, don't do it, Jacob. Send the clean. Oh, There you go. Well, I don't even know what that means. CC is. I'm reading our group text. The point is, at some point in time, there's going to have to be justification for this capex spend, and this is just. I got this off of Bloomberg. I mean, this speaks to exactly what's going on. NVIDIA's in the middle of this, but you see, again, the circular nature of all the spend. And can it go on in perpetuity? I don't think so, is the point. And the numbers are huge, and they're all interconnected. But at some point, again, you have to start to see a return on invested capital. And we're not at the point where the market cares, but there will come a point, Elizabeth, where the market does care.
Well, I think the market's going to care in 2026. That's not to say that suddenly all of this comes to an end in 2026. But I think the companies get held to the screws a little bit more on what the spending is actually producing. That started to happen in 2025. And then we got very distracted with tariffs and a lot of other stuff that was going on. But this is, this diagram, and we've seen a lot of different versions of this same diagram. I also want to be clear, so far, it doesn't seem like there's anything nefarious going on, right? No. This isn't like a predictor back in 2008 where there was actually nefarious behavior going on, right? Bad lending and all the different layers of complexity and all of that. So I don't think there's any of that going on here yet. Granted, I don't run one of these companies. I'm not in the rooms that are making these big decisions, but everything depending on everybody else is a risk. And you've got, it's a house of cards that gets sort of built up, and you blow out one of the little pillars and the whole thing comes down. So this is something to be careful of. I do think that, and we've talked about this so many times, AI will change the world, and it already has changed the world. But the companies that are involved in it and the ones that will win, or the things that will take it forward, are just not the same as what's happening today. That's not to say that the ones that are winning today won't continue to win, but new ones are likely to come in. Competition will change. The landscape will change. The use cases will change. We are early in the life cycle of this as a technology revolution. And the market's reaction to it right now sometimes is acting like we're not all that early. It's getting a little too interconnected.
Tax the rich, feed the poor, till there are no rich no more. I'd love to change the world, but I don't know what to do, so I'll leave it up to you. Of course, that's lyrics from the great band 10 Years After.
Of course.
I know, yeah. I mean, think about these lyrics. World pollution, there's no solution. Institution, electrocution. I mean, this goes back 50-something years. Anywho, sorry, there's one comment in here I'm not going to get out of here without mentioning. It says, once my Cubs lose, is there room for me? There it is. Is there room for me on the bandwagon for my home state Brewers? First of all, if you live in Wisconsin and you're rooting for the Cubs, we need to talk about that. We know Mike. We got to talk about your choices. We do know Mike. He's a great Packer fan, but I didn't know he was a Cubs trader. So, Mike, let's work on your choices, first of all. But yes, we welcome all fans onto the Brewers bandwagon. Well, see, that's magnanimous of you. If you were to ask me a similar question, I would say, again, I'll spare the vernacular, but I'd be like, no effing way. I mean, we don't need any of these Johnny-come-latelys. No, there is no frickin' room. And how in the world are you a Cubs fan from the heralding? I mean, it makes zero sense.
Maybe he lives in like Pleasant Prairie, which is right on the border. I don't know.
There's a place called Pleasant Prairie.
Correct.
Population of like 9.
Population Michael Cole.
She's Elizabeth Thomas. I'm G Swizzle. Always great to have you. Always great to have Butters work. We have Danny Moses and I are actually doing a podcast on Thursday. We'll drop on Friday. That's going to be fun. And that's pretty much it. Dan and I are back together for Market Call tomorrow, being Thursday. Yankees play this evening, as I mentioned. I'll say it again. Cam Schlittler on the hill. And I'm just going to say this now. There's a very good chance that you see a change at the shortstop position. Oh. Anthony Volpe seems lost at the dish. I love the kid, but I think he struck out like 12 times in this series, which is just, it's unacceptable, as you know.
Nerves getting him, huh? On a
Something.
Bad streak. Okay.
Well, you know what? I'll say, sorry about this, Amanda. Go back and watch the movie The Natural and see what happens to to Robert Redford midway through, and I think it's mirroring some of the things that we're seeing here in Yankee Land. But we'll talk about it at a later date. With that said, thanks everybody.